Hola, hola, hola. What is going on, folks? Here we are. Here we are. Okay. Mean reversion. Mean reversion. This is it's a bigger conversation than than many would think. While I prepared for this, while I prepared for this presentation, I myself came to realize that mean reversion, mean reversion accounted for a, a good amount of my trading strategies. You know, you'd be surprised how many trading strategies that we utilize on a day-to-day basis actually do fall into this category, right? Now, today we're going to talk about defining mean reversion, causality, and we're going to go over a few examples, right? But the reason we want to talk causality is because everything always sounds so good. It always sounds so good, right? Oh, if we if we see the market break out in a big way, right? Chances are it's gonna mean revert. It's gonna come back to the averages. That sounds really good, right? Um, it's always something that you know if you put it in front of a group of traders, it's gonna sound like something they want to do because it's a beautiful setup. But the reality is that most people don't actually understand mean reversion as far as well what really causes it. What really causes it? That's what you need to be thinking about. What is the causality? Why does it happen? That's what we need to think about. All right. First, let's get into the definition. Mean reversion is a financial theory that suggests asset prices and returns, after deviating significantly from their historical averages, will eventually tend to move back towards those averages. This concept is widely used in various financial time series data, including price, earnings, and book value. Traders use technical indicators like relative strength, right, index, the RSI, and Bollinger Bands to identify when an asset's price is significantly above or below its historical mean. The greater the deviation from the mean, the higher the probability of a price reversal, or the greater the probability of a reversion. Now, traders may sell an overbought asset expecting the price to fall, or buy an oversold asset expecting the price to rise towards the mean. Um, some examples: moving average reversion. Um, a guy that we talk about pretty often by the name of Oliver Velez, he'd say, well, that 20 MA, right, the 20-day moving average, can deviate pretty far away from the 200-day moving average, but eventually it always seems to return. You have pairs trading, which is arbitrage, right? Two things that are usually closely, right, in motion with each other that eventually deviate from that aligned path, and then all of a sudden they get back. They get back to it. Bollinger Bands. This has to deal with standard deviations. You guys, if you've been around me long enough, you know it's one of my favorite things to study. Standard deviations. So Bollinger Bands, they take the 20-day moving average. You could use different averages, right? And they measure the market's deviation away from that. And they have bands moving along the 20-day moving average, exactly 2 standard deviations out at all times. So that way you know when it happens. Right? And that'll give you an opportunity to take a trade back towards the average and back towards the other side of that band. You have growth mean reversion. Right? This one's going to be interesting. We'll talk a little bit about this today as well. This one's going to be interesting. Right? The economy, the stock market, uh, your favorite company, whatever it is, they grow at a certain pace on average. For the economy, that's known as trend growth. Oh, and then all of a sudden, 1 year, things break down, like COVID, for example. All of a sudden, you have this extreme drop off in growth, right? Eventually, things get back to where they were. What causes mean reversion, though? That's what we're going to talk about. What causes things to get back to where they are? And are those things predictable? That's another question. Are those things predictable? My argument today is going to be that those things are predictable. I think they are. So we'll talk about why they're predictable and how, quite frankly, most of the individuals listening right now, most of you guys have the ability to predict these things just as well as I do. I think you're going to realize that once I tell you how simple some of these things are. I think you're going to realize it. You have cyclical reversions, right? Think sales, right? Certain companies, they just do better sales at different times, right? You have, you know, certain companies who just do better sales in September, right? In the fourth quarter or the first quarter, so on and so forth. These are just things that happen. Home sales, right? They do well at certain periods during the year. Retail sales do better at certain periods during the year, right? There's a certain expectation, right? And if you can take advantage of it, you can. All right, I'll tell you guys about one of the favorite things I used to do of all times, because it's really about expectation. I had this one thing that I used to do always, every year, until until 2020, when I decided to let that thing go, and we'll talk about why. Right? It's all about, is it predictable? Right? Is there something about it that's predictable that you can use? Now, the last one is valuation reversals, right, or reversions. Another one we're going to talk about today. Whether it's for a specific sector, right? It could be for a sector of the market. It could be for a certain stock. I'll show you guys an example of this, right? I'll let you pick a stock. Matter of fact, throw some stocks in the chat right now if you can. Throw a few ticker symbols in the chat because I'm gonna use one of them when the time comes. I'll pick one at random. Um, Whatever you want to look at, and we're gonna use that stock, whatever one I pick at random, as a you know as a way to gauge valuation reversions, and it'll be a great case study for later on, right? It'll be a great case study for later on because we'll look back at it and see if in fact what I'm speaking of today comes to fruition. All right, let's keep going. Let's keep going. All right. Now, this is the big topic right here. This is the big topic. What leads to mean reversions? The mean reversion is not merely a spontaneous correction, right? It's often a two-stage process. In many instances, the market first enters a state of disequilibrium, becoming ripe for reversion. What that means is it's the first thing that you notice. You happen to notice that the market just shot up randomly, right? Goes through the roof, finds its way to levels that you've never seen before, or has these extremely big days. Some of you guys remember I used to say this one thing. I used to say some of the best days are followed by some of the worst, and vice versa. Some of the worst days are followed by some of the best. Remember, I used to say that all the time. This is why, because you know, when these moments come, that's usually the setup. That's usually that thing that catches your attention. Now, just because that thing happens does not mean that you're all of a sudden going to have a mean reversion. All right? That ripeness might stem from an extended period of irrational exuberance or excessive pessimism, where prices significantly diverge from underlying fundamentals due to emotional trading, speculation, or herd behavior. Right? AKA crowded trades. We've talked about that in the past. Now, the market develops an inherent instability, creating a growing disparity between price and value. Now, for the most part, that's usually the at the core of mean reversion strategies is instability and mispricing. Right? Now, while this state of readiness can persist for some time, it often takes a catalytic event to trigger the actual reversion. That's what I'm talking about today. Right? The catalyst could be unexpected news. I want you to think about that one because you got some on Friday, didn't you? Right? You got some of that unexpected news on Friday. It could be a shift in economic data, a change in monetary policy, or even a prominent analyst downgrade or upgrade, which then serves as the impetus for investors to reassess the asset's true value, leading to a rapid unwinding of the mispricing and a return towards the historical mean or the average. All right. Now this could be the unwinding of short positions or long positions. Doesn't really matter. All right. The question is what makes it happen? What makes it happen? All right. And in the event of short positions, all right, that one is quite unique because if I'm in a market that people are shorting in a major way, then the reality is one major catalyst for the unwinding of those positions is simply the motivation of a loss of money. They're motivated by pain, right? They're motivated by pain. And that's all the motivation they need. And all of a sudden, the market goes from extremely oversold in a heartbeat back to, right, fair value, right? Back towards fair value. Now, apparently, mean reversion can occur more gradually. Alternatively, mean reversion can occur more gradually as the market itself realizes an opportunity without a single dramatic event. In these cases, the market isn't necessarily driven by emotional extremes, but rather a slow, dawning recognition of mispricing. This might happen when diligent analysts, value investors, or arbitrageurs identify a significant divergence between an asset's price and its intrinsic value over time. They begin to accumulate or divest, right? Slowly correcting the imbalance, right? And by divest, we mean, right, we're in the distribution phase, right? What's on the opposite side of accumulation? It's distribution, right? So, in other words, every mean reversion isn't going to look the same. It's on you that if you decide to adopt these strategies, that you don't put yourself in a position where what's expected to happen always has to happen in such a short period of time or you lose money, right? Put yourself in the right position. You know, that's one of my favorite things to talk about, right? Position yourself well, and the market will reward you for that. Let's keep going. The process is driven by the rational pursuit of profit as market participants identify and exploit the statistical tendency of prices to gravitate towards their long-term average. All right. The cause of the reversion is collective, logical behavior of market participants seeking to capitalize on a perceived undervaluation or overvaluation, steadily pushing the price back towards its equilibrium or fair value. Here we go. This image number one, this illustration, it seems very simple, right? That arrow shooting up the middle is your average price. All right. Price pushes up and away from the average. Eventually, it always comes back down to the average. Notice the arrow is on a steady trajectory to the up, right? Upward and to the right. There's a reason for that. There's a reason for that. Because over time, this stock would have proven itself to continue to rise. And no matter how dramatic, listen to me very carefully, guys. No matter how dramatic the ups and downs are for a stock, the average will always, always, always point out the true trajectory of that stock or that asset. Let's go with the word asset from now on. We're gonna go with asset from now on, so that way we're clear. This can be anything, right? This can be a currency, this can be an index, this can be a stock, a company, this can be the price of gold, this can be the price of oil, a commodity. This can be whatever it is. No matter how erratic the price movement is, the average will eventually show the true trajectory. And the longer term the average is, the easier it is to see the trajectory, the true trajectory of that price movement. Okay? In this particular example, we would assume that this is maybe the 50, the 100, or the 200-day moving average, right? Something of that nature, something longer term, right? Something longer term, something more, uh, something longer term, something more, uh, stable. All right? Give me 1 second here, guys. All right. Now, here's the deal. Let's keep going here. All right. We're going to look at some different types of, we'll look at some different types of mean reversions. Okay. We're going to look at some different types of mean reversions. All right. And this first one I want to show you is pretty much exactly like the one that you've seen before. But it paints two scenarios here. Because the one thing you're going to have to do as a trader, like anybody has to do, is accept every scenario. Accept every scenario. Here's the reality. Like I said, when you witness some sort of a move, some sort of a reversion away, right? I'm sorry, an impulse. I meant to say an impulse move away from an average, right? This right here, this move right here, boom. When you notice that, that's gonna look like it's being overdone. It's gonna look like, oh, that was too much in too little period of time. That's gotta do this. It's gotta do that. You're gonna start getting those thoughts in your mind, right? But here's the reality. The reality is you don't know what's too much just yet. The market will tell you what's too much. What you can be able to tell is whether or not the market will work its way back to that average sooner or later. Right? And I don't mean that as the traditional term sooner or later. I mean there's two scenarios here, right? Sooner or later. Okay? And you have to be determining whether or not this is something that you see happening right away, right? Is this something that you believe is going to happen over the next week, 2 weeks, 1 month? Or is this something that you believe could take 90 days, right? Something of that nature. So the market then pushes to the downside, okay? Market then moves to the downside, and then you start to see this potential of a mean reversion. You take the trade, all right? Two scenarios here. The mean reversion actually happens, all right? You get to take your profit and move on with your life. Second scenario, all right? The trend actually continues. The market keeps going in the direction that you actually predicted that it would not, right? You experience some losses, but you cut those losses very short, and you move on with your life. There's more things to be done. There's more trades to be had in the future, right? So understand this. You're not going to be right about everything all the time. But mean reversion is one of those things that if you can learn to predict, if you can learn to see ahead of time the things that may come about and cause those reversions, not the reversion itself. See, here's what I believe a lot of people are going to end up doing. I'm not talking about you guys, because you guys are going to listen to what I'm saying today, and that's going to help you out. But a lot of people that hear about mean reversion, what they're going to end up doing is they're going to end up seeing this right here, this move right here, boom. And they're going to end up saying, oh yeah, that's too much. I'm gonna take a long right there. This market's going back up. And they're going to catch this instead. Boom, they're going to catch scenario B. Why? Because they didn't bother to think what, they didn't bother to think, well, what's going to cause that reversion? What makes that happen? They didn't bother to think about that. And here's the reality. Here's the real reality. All right? You really can think of some of these things, you know? Recently, we took that long volatility position, and we'll talk a lot about that soon enough. Right? When we get over to the to using the charts and whatnot. We took this long volatility position. That in itself was a mean reversion trade. We were saying that on average, the market tends to have a higher implied volatility. The market tends to have a higher implied volatility. So we took that position, we took that trade, and we said to ourselves, well, it's more likely that something happens that shakes the market up and increases the implied volatility than it is the market will break through this strong resistance at 6,100 and break out to the upside. We had two scenarios. We knew one was more likely than the other. We took the position. We're currently winning. All right, let's keep going. Here's another one. These are all examples of what mean reversion looks like. I repeat, these are all examples of what mean reversion looks like. This is the CAPE ratio, right? So this is price to earnings. This is the PE ratio of the S&P 500. So you have the average 16.8. And you can see what these deviations from the average, you can see it clearly, clear as day, right? Every single time you make a major deviation away from this average, it becomes more and more predictable that the market is either overvalued or undervalued. Okay? But remember, the question is, well, what's going to cause the market to all of a sudden change its mind about these valuations? Right? What's going to make these big money guys want to spend their money? When we're at the lows down here, it's greed. Listen to me very carefully. I know common consensus is that up here is where the greed is, and down here is where the fear is. Let me help you out with something. All right? Down here is where the real greed is. Down here is where the real greed is. Let me explain it to you. Right? While everybody panics, while the average Joe panics and sells everything he owns because he thinks it's over and things will never be the same again. The individuals who truly understand are chopping at the bits and they're loving every minute of it because they know the true value of what's being sold. Imagine not that long ago in the commercial real estate space, some of you guys were sitting right with me when we saw the transfer of ownership of a piece of commercial property for $1. You thought that was just that was the type of stuff that only happened in movies, right? That's what you thought until you witnessed it, right? Does anybody remember that? I don't know if anybody is in the stream right now and they remember that. Anybody in the stream and they remember that, right? They wanted to transfer the ownership of this. They wanted to transfer the ownership of this commercial property. I can't remember, all the details, right? Yes, it does work for SPY. Yes, the mean reversion does work for SPY. All right. But yeah, so these guys wanted to transfer ownership of a commercial property to get the risk off of their balance sheet. And so you ended up getting the transfer of ownership of this commercial property for $1, just so they can get off their balance sheet. Right? Now, what do you think? What do you think these guys were thinking? Right? The ones that actually, got to take ownership of it for $1. Right? See, that's what's happening down here. Right? That's where the real greed is. Right? Up here, sure. Right? It's extreme greed for those who don't understand. Because they see this and they think, wow, things are booming right now. I want to buy in. But in reality, this is where the real fear is. This is where the individuals who really understand what's going on, that's where they're afraid. That's where the real uncertainty is. That's where they say, man, I don't know how we're going to fix this mess without causing what? A panic. See how that works? How do we fix this mess without causing a panic? The real ones are afraid up here and they're greedy down here. You remember I told you that. So this right here is another reversion strategy. So up here, we start preparing ourselves for the reintroduction of volatility into the market. Down here, we start preparing ourselves for the reintroduction. When I say reintroduction, I mean reversion, by the way. Okay? Down here, we start preparing ourselves for the reintroduction to, prominence, prosperity. Because see, down here, things are painful, right? Liquidity dries up. And if you know, like I know, when liquidity dries up, somebody is going to come rolling in with a big, fat check. Here's another one. This one is for pairs trading. So, identify a co-integrated pair. You guys remember I like to look at AMD and Micron. No, they don't sell the same type of chips per se, but they both tend to have a this up and down relationship, right? That really works well. You calculate the price spread. In TradingView, you can go one stock divided by the other. You can actually do that in TradingView. I'll show it to you in a few. Right? You determine the entry threshold, all that stuff. Don't worry about this stuff here, right? Here's the key deal. Right? This is the price spread. The price spread. This is the average. So essentially, what they're saying is, when stock A, when stock B is gaining on stock A, that spread's going to fall. Okay? When stock A is gaining on stock B, that spread's going to fall. Right? And so eventually, that spread will, eventually that spread will return back to the average. Now, what we really like to see is that spread shift dramatically and suddenly. That's what we really like to see. All right? And so we talked about, well, what are some of the things that you can predict that are happening? It's usually earnings. Right? So Micron announces earnings and they say something that's very exciting, right? And all of a sudden, Micron shoots through the roof. They're up 16% on the day or something like that. All right? Well, AMD, right? And so Micron would be stock B, by the way. So what's going to happen is, boom, the spread between the two is going to drop like this. Okay? So in this type of a mean reversion strategy, what happens is Micron becomes the short position because, well, it's most likely that we overreacted. AMD becomes a long position because, well, in reality, if something good is happening for Micron in the semiconductor space, well, something good may be on the way for AMD as well. Or even so, people may realize that AMD at this moment in time is a bit undervalued. We're a bit crowded into the micron trade, all right? And we're always crowded in Nvidia. So, AMD may become the beneficiary of some added enthusiasm about semiconductors, right? And so this becomes one of those trades. And eventually, as they get back towards the average spread that you're used to seeing from these two companies, see, let me break it down for you even deeper. There's usually a reason for that spread between two companies. In fact, there's usually a reality that one company is simply doing better than the other. So they're usually seeing, uh, uh, you know, a spread that's also widening over time as well. So that spread will also be going in a certain direction. Right? But nonetheless, when that spread is disrupted, that becomes your opportunity to trade the reversion. So I want you to think about that. It's something that people don't often think about, right? When two companies in the same space all of a sudden diverge from each other, right? So when you see some of these companies sometimes, exploding or plummeting in value, I would challenge you to sometimes look for the related companies, right? And take opposing positions in both, as opposed to trying to guess what's going to happen next between the either or, right? And sometimes you can make it neutral and equal weight, meaning I can have the same amount of money in both and the same amount of delta in both. And so whichever way this shifts, the money is, very easy to make, right? At that point, all you need is movement. At that point, all you need is movement. So in other words, say, you know, Amazon or Walmart, one of these guys, finally break the mold, and all of a sudden retail is not so under attack anymore. For example, and one of them just, like we said, it just explodes, right? Um, you may say, okay, you know what? Based on what's going on right now, I'm gonna go. I'm gonna go long Walmart. I'm gonna go short Amazon. I'm gonna wait for them to converge again. You'd be surprised at how many times out of 10 that's going to make money. All right, let's keep going. Now, this one right here is another big strategy here, right? And let me rephrase that. Not strategy. It's another big illustration. I meant to say, right? Because this one really highlights the entirety, the totality of what I'm trying to say to you, right? And that is, we're dealing with two factors: high risk and low risk. High risk and low risk, right? If I were to look at every single one of those strategies that I've shown you, right? Different points of divergence are going to represent either higher risk or lower risk. When I showed you the cyclical, the PE ratio, right, for the SP 500, when we were all the way up there, right, dot-com bubble levels, higher risk. When we were down 1921 levels, lower risk, right? And in those moments, guess what? The growth rate of the market was all the way up here during the dot-com bubble, all the way down here during the 1921 financial crisis. You see, these are the types of things that you need to think about. All right. So, rate of growth is behind a lot of this stuff. It's behind a lot of it. When you think about what's going to happen in the economy, right? I'll give you an example, right? So during COVID, when COVID struck, this is what it looked like right here, right? Below average growth. Okay. After COVID, when we went into 2021, this is what it looked like right here, above average growth. All right. What are some of the things that are going to happen? Down here, the Fed's going to respond with expansionary policy. So is the government, right? Up here, the Fed's going to respond with contractionary policy. So is the government, right? AKA, down here, they put money in, they give us money. Up here, they take money away, right? You understand? These are the realities. These are the realities. All right. Shout out for the follow. Much appreciated. Shout out for the follow. Let's see what we got. Let's see what we got here. A divine purpose. Sorry. I am divine and purpose. Shout out for the follow. Shout out for the follow. Much appreciated. All right. And we just hit our goal, right? We just hit our goal. All right. So you've done well. You've done well. So that's the premise of mean reversion, right? Is that it's not about the fact that this happened. That's the thing. It's not about the fact that this happened right here. It's not about that. It's about what gets us back down here. That's what it's really all about. So when we get back to this Q&A session, right? When we get back to that, I want you guys to really, if you got questions, these are the questions I want you to ask. Okay? I want you really focusing on those things. Okay? As I said, when we enter these higher risk moments where the market is overvalued and we're being overly speculative, we're buying into everything, right? Oh, the market can do no wrong. It can only go up, yada yada yada. Right? What's gonna make this happen is that the Fed's gonna, right, pull money out, right? Reduce their balance sheet and raise interest rates. Because the likelihood is that while this was happening, other things that don't work so well were happening, like higher inflation and so on and so forth. Right? Okay. What if we were talking about the market with this one? What if we were talking about the growth rate of earnings? What if that's what we were talking about? All right. Watch this. Okay. So the growth rate of Tesla, I want you guys to remember when Tesla hit, this is about 2021, right? When they started saying that Tesla was going to grow their earnings by 50% per year for the next 5 years, right? Remember that. Because in those moments, that wasn't likely to happen, right? That was those moments where we just were expecting so much growth, it was a risk, right? I want you to think about that, okay? In those moments where the growth of the S&P 500 was at a you know at a 20-year high. We haven't seen growth like this in a long time. Stuff like that. Expect reversions, right? The fact of the matter is that mean reversion is a bigger tool than most people think it is. It's not just about, I think the market is going up or down or returning to the averages. It's about more than that. I can use mean reversion as a way to understand so many things. You probably don't even understand you use it in life every day, right? That person at work that's always blowing up at somebody, they ain't blowing up at, they haven't blown up at somebody in 3 or 4 days, and you're like, it's just a matter of time, right? What are they showing you that they're doing on average, right? The thought process behind mean reversion is what I want you to understand today. And that's what I want you to leave with today. The thought process behind it is about more than just strategies. Those few things that I showed you guys today, that's fine. That's fine and dandy. Like, yeah, okay, cool. I showed you a few of them that'll work. But you can recognize patterns in the market yourself. It's about more than that, though. It's about now that I've recognized this pattern, now that I've recognized um, this average state of movement of the market, now that I've noticed that, and now that we've gotten away from that, what is likely to be the next move? If you believe it's going to be a reversion, if you believe we're coming back to the average, what's going to cause that to happen? Right? That's what I'm talking about. Right? All these little strategies right here. Right? All these little strategies. Right? Moving average reversions. Right? The arbitrage trading. Right? Your Bollinger Bands. Your RSI reversions. Right? I just got done showing you growth. All these things. When you believe they're more likely to happen, the big question is why? If you don't ask yourself, why is this going to happen? You're going to take more losses than necessary trying to trade a reversion. I can assure you that. All right. Let's go over to the charts real quick. Take a look at some things. Going over to the chart. All right. So here's the deal. All right. Um, on Friday, you got a market that was more volatile than it had been in a very long time. But guess what? Guess what though? Even though you got a market that was more volatile than it had been in a very long time, that wasn't extraordinary. That was actually a return. That was a reversion. Because where were we? Where were we before that? Right? We were in a low volatility environment. We were in a low volatility environment. And, you know, there weren't many times where volatility was lower. Right? Now, historic volatility 14.53, implied volatility 16.18. All of a sudden, we're above historic volatility now. All of a sudden, you see, we were waiting for that. We were waiting for it. That was a reversion. That was a return to higher volatility. Now, I'm gonna be honest with you guys. I don't, you know, I'm not a big fan of the way it happened. I'm not a big fan of war and people dying for money and those types of things. I'm not a big fan of the way it happened. The point still remains, though, right? That this was a reversion, right? The IV percentile is now at 72%. That means that 72% of the time the implied volatility is lower than where it is right now. Not that long ago, this number was 14%. 14%, which means that 86% of the time, implied volatility was higher than where it was. This wasn't that long ago. Okay? So you had below average volatility. Which means when it's all said and done, that the reversion was likely to be a return to higher volatility. Okay? I'm just giving you guys an idea of these examples of how volatility, right, itself can be one of those things. Let's keep going though. Let's go back over to the charts. This is your pivot point. The pivot point is the average between the high, the low, and the close. Last week, when the implied volatility increased in the market, we fell right back. Right? We fell right back to that pivot point. Shout out to Genia for the follow, for the subscribe. Appreciate it. All right, 2 months in, I see you. All right, always good to keep subscribers happy and whatnot. So again, this is that point that you need to look at right here, right? When that volatility returned to the market, we immediately pushed down to the weekly pivot. We reverted back to the weekly pivot, and that is around the area where we closed. Okay, that's around the area where we closed. Things you got to think about. All right, things you need to think about. We can also talk about average direction of the market as well. Right, so like right now, at this very moment, for now, the market is trending higher. So also, when you get these strong moves to the downside and stuff like that, a lot of that ends up being looked at as opportunities to trade reversions back into the current trend. So people look at it that way as well. Right? But let me show you guys what this looks like on a 30-minute chart here. Look at this. All right? Look at that. A move higher, reversion to the mean, right? A move higher, reversion to the mean. A move higher, reversion to the mean. This 200-day moving average has been providing us, right, with these reversions on the 30-minute chart since the end of May. Right? Since the end of May. They've been providing us with these reversions. And so this situation happens on Friday with Iran and Israel, and the market is sucked back into its shell. Right? Renji, what's up, man? Shout out for the follow. Good looks. Right? So I repeat, the situation happens on Friday, and the market is shocked back into its shell, another reversion to the mean. Now the question is now, what's happening next? Right? Do we see a move back away and back to the upside again? Or does the market continue now in this direction, set a new trend, and your reversions are now back to the upside? That's your question now. That's your question now. The other question is, how low will the market go when it goes that low? Now, watch this. Let me show you something. Check this out. Because the VIX. I'm going to go to the weekly chart because it's easier this way. All right. See those spikes? See those spikes in that VIX? Let's go to the monthly chart, actually. Let's go to the monthly. Let's keep it more simple. See all those spikes? All right. One of the most predictable things on the planet is a reversion to lower volatility. Let me remind you guys of something I said earlier. That understanding a reversion to the mean is it's more than just understanding what you expect to see in the market. This thing is applicable in so many walks of life. It's applicable in so many walks of life. I'm just going to keep it really simple, right? I want y'all to help me out. I'm going to ask y'all a question. I just want everybody to just, pile in with your answers in the chat. Okay? Here's a question for you. If in your city right now, right, all of a sudden, all of the fire hydrants just exploded and water started shooting up into the sky and onto the streets, what do you think the response would be to that newfound chaos? Again, all of your fire hydrants just exploded. Boom, water shooting up into the sky and onto the streets. What do you think the response would be to that newfound chaos? Tell me some of the things that you think you would see. What might happen as that water shoots up and okay, Cecily says rapid response. No. Not the type of response. I'm saying what do you think? Okay, so yes, you're gonna get a rapid response. So Anisha says flooding, Gina says flooding. Okay. Cece says shut the water off. That's what I'm talking about. Okay. Watch this now. Why are they shutting the water off? Look at what Anisha said. Look at what Genia said. Because it's flooding. Think about what I'm saying, guys. Y'all understand what I'm saying? Atlanta says block off the streets. Look at that. Right? Cut off the traffic. Okay, people gonna start filling water containers. Okay, they're not used to all this water just flowing out. Okay, filling up water containers. They're like, hey, free water, right? Insurance claims. Okay, houses are going to get damaged. Okay, let's talk about it. Watch this now. Let's go through all these. Let's go through all these things here. Look at this. Anybody else? Anybody else? Anybody else got anything they want to put in? Let's go with what we got here so far. Let's go with it. Watch this. So, right, Candace says it has to be addressed, right? So they address it. You know, electricity might shut down. Okay, okay. All right, I agree with that. They might shut down the electricity too. Okay, we may end up with no water. Okay, okay. Now watch this now. So everything you guys are talking about right now is either out of the normal or a response to things becoming out of the normal. Would you guys agree with that? Shut down the subway. Okay, there you go. Everything you guys are talking about is either out of the normal or a response to things being out of the normal. Would you guys agree with that? Yes or no? Yes or no? Ah, it's either out of the normal or it's a response to things being out of the normal. I'm trying to explain to you guys here that a reversion to the mean is more than meets the eye. It's more than meets the eye. It's so far beyond that. People don't really understand it. I'm explaining it to you now. Watch this. So all this chaos comes in and things start to change, right? All of a sudden, all the members of the community, the electricity gets shut off. Your water pressure is low, or you have no water at all. Your streets are flooding, right? For some of you, they won't even let you come home, right? They won't even let you come home. They're like, hey, sorry, we can't let you down on the street right now. Okay? Now, let's go with the solution. I see only a few people posted the solution. The solution, the quickest solution is to do what? What's the quickest solution? Cut the water off. Would you guys agree with that? Quickest solution is to shut the water off, right? Turn it off. Okay. But now let's talk about why they're shutting the water off. For starters, it's because it's flooding and it's dangerous. Because it's flooding and it's dangerous. So when it comes down to a mean reversion strategy, right? When it comes down to a mean reversion strategy, right, and drain the water, right? Before it becomes a health concern, okay? But the goal is to get things back to normal, right? So there are several things that you would expect might happen, okay? So they shut off the water, they shut off the electricity. Don't want anybody getting electrocuted, right? They cut off they cut off the traffic. These are all things that happen in response to the flooding, the dangerous levels of water, and the hazards of potential. Oh, okay. So Christopher said shut off the gas too. Okay, shut off the gas. And he shut off the gas as well. Now watch this now. You see how you guys responded with what's likely to happen? Let's see. That's what I meant when I said you don't look at the the deviation away from what's normal. You don't look at the deviation away from what's normal as the opportunity. No, you don't. You look at what's likely to cause the shift back to the normal as the opportunity. I'm just pausing on that one. You look for what's likely to cause that shift as the opportunity. Okay? So guess what? It was pretty easy to predict that they might shut the water off. Hmm. Interesting, huh? So if they might shut the water off, then I might, right? If I was taking a trade, and that was an option, then I'd be betting they're gonna shut the water off. I'm gonna make some money, right? If it was a trading opportunity that I can bet that they would shut the electricity off, and then I'm gonna make some money, right? If it was a trading opportunity that they would call this what do they call this, a national emergency, and rush to drain the streets of this water, then I'd be taking the right trade. I'd be making some money. You see how that works? That's how you think about me in reversion. Everything you guys just did in that moment when I asked you what are the problems and what are the solutions to that problem, that's how you think about me in reversion. Look at here. Looking at this VIX, let me ask you guys a question. When you look at this VIX all the way up here, what's the problem? What's the problem with this? Somebody tell me. What's the problem when the VIX is this high? There's got to be a problem happening, right? Usually, problems create these spikes in the VIX. And what we do is we find solutions to these problems. The same way you said, oh, they're going to come in and they're going to drain the streets. Well, I'll tell you what, in 2008, right here, this spike in the VIX right here, you see it. In 2008, this big old spike in the VIX right here. They said, I tell you what, we're going to buy some assets from the bank. We're gonna put money on their books, and we're gonna stabilize the financial system. And we're gonna make sure that these things don't collapse. Now, granted, everything didn't go exactly how they wanted it to go, but they did prevent more banks from collapsing, and hence, eventually things worked themselves out. Right? Okay. 2020. Right? Massive stimulus. Yada yada yada. Blah 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 blah. You know the rest of that story. I'm not gonna go there. Right? Lower interest rates, all that stuff. Okay. You gotta understand this stuff, guys. Right here, 2024. Ooh, this was a close one. This was a close one. Japan said they're going to raise interest rates and boost the value of their currency. You know what the solution was here? Japan changed their mind and said, you know what, never mind, we're not going to do it. But I'll tell you what, that was a better negotiating tactic than anything I ever seen Joe Biden do, Donald Trump do. There's no better negotiating tactic than to say, I'm going to raise the value of the Japanese yen. You want negotiations? That's a negotiation. I promise you that one will change your life. Okay? But the point remains that when you see a spike like this in the VIX, there's usually a solution on the way. All you have to do is determine when this spike in the VIX aligns with a bottom in the market. When do you see those solutions coming? Now, sometimes what's happened is so dramatic that what's coming next is just more than probable. You just know that something is coming to make that change. You just know it, right? In 2021, when they said, hey, we're going to raise interest rates, that was that thing that was coming in to change that, right? When inflation spiked, Did anybody think that there was that inflation stay that high? Did anybody think they were going to let inflation stay that high? No. What's the response to higher inflation? Right? Higher interest rates. So, right then and there, you knew that higher inflation was the first signal that a reversion to the mean was coming in the market. Because in order to do that, in order to get that reversion to the mean, you needed something to come in and break this trend, and higher interest rates will do it. Okay? So, for those that are not currently, if you're not currently, you know, the part of our Clubhouse community, um, you can feel free to join us over there when you get a chance. I'm going to put the link in the chat. Right? It's coming in there right now. In 3, 2, 1. There it is. All right. Feel free to join us over there on Clubhouse. That's where I'm going to be doing the Q&A for tonight's session. All right. We're going to go over there. We're going to have a nice conversation. We're going to, talk for about another 15 to 30 minutes. And I'm going to answer some questions that you guys have. But hopefully this helps you guys realize that reversion to the mean is more than just about seeing things move away from an average and pull back to it. Right? It's about everything behind that. Right? It's about the reasoning. It's about the logic. Right? Even life itself plays a role in how the market reverts back to old trends. Even when you think about growth, when you think about all these different elements, right? This is like one of those strategies that pretty much encompasses so many others. Right? I can connect probably 80% of my strategies to mean reversion. Right? Because that's how interconnected it is to everything else. Right? So I hope you guys learned something today that you can take with you. My goal tonight was to spark the thought. My goal tonight was to spark the thought. That's what my goal was. To get you thinking differently about what mean reversion is actually like. Right? To get you thinking differently about how you can incorporate mean reversion into what you do. Right? It was to get you thinking, maybe before I take this trade, I better at least think about what are my expectations of what's actually about to happen here. Right? My goal was to spark a thought, and I hope I did that. Okay? I'll be talking to you guys on Clubhouse. You can swing over there when you're ready. I put the link in the chat. It's that big long link that's in there. I don't know why it's so I don't know why that link is so huge. But come join us on Clubhouse, guys. If you don't have the Clubhouse app, download the Clubhouse app and look for the Equity channel on Clubhouse, and you'll see us in a session over there. All right. Looking forward to seeing you guys there. Come join us for the Q&A. All right. Other than that, everybody be blessed. Stay well. And we'll talk soon. Oh, by the way, this session will also be uploaded to YouTube. So go find the Equity channel on YouTube. All right. And subscribe over there as well. All right. Later, guys.